Good evening and welcome to another Closing Bell market update here on this YouTube channel. Today is Thursday, the 18th of May, 2023. And here are today's topics. Of course, we will start off by summarizing today's trading day. I will summarize all the comments that we got from Federal Reserve officials throughout the trading day. We will talk about jobless claims, the debt ceiling debate, which continues to move markets. And we will also analyze the Walmart earnings and summarize all the other earnings that we got from retailers throughout the week. And then we will talk about opportunities in fixed income. But first of all, let us summarize today's trading day. The S&P 500, the Dow Jones, the Nasdaq Composite, the Dow 30, the Nasdaq Composite, all up today. The S&P 500 finished the trading day in the green with around 0.9%. The Dow 30 up by 0.3%. And the Nasdaq 100 up by more than 1.5%. US Treasury yields are up across the curve. Once again, short and long end at the belly of the curve. Treasury yields are up. The 13-week Treasury bill at the very short end of the curve up by 0.7%. The 30-year yield at the very long end of the curve here up by 0.6%. And the 5-year Treasury yield up by 2.9% and increased to 3.6. It is very interesting that the 2-year yield, which is not on this chart right now, but the 2-year yield actually now clearly exceeded the 4% mark. Investors are more optimistic about the economy. We are getting hawkish comments from Federal Reserve officials, which is kind of causing the yield curve to steepen again at the very long end. Very, very. All right, let us start off with our first topic today, which is comments from Federal Reserve officials. Governor Jefferson, the Dallas and St. Louis Fed president, relatively hawkish comments. The Dallas Fed president Logan said today that we haven't yet made the progress we need to make, and it's a long way from here to 2% inflation. She also said that, quote, the data in coming weeks could yet show that it is appropriate to skip a meeting. As of today, though, we're not there yet. If you look at the CME Federal Reserve Watch tool, the federal funds futures are now pricing in a 66% chance of a pause at the next meeting and a 34% chance of another rate hike. Now, Dallas Fed President Logan, she does sound relatively hawkish. She acknowledges the fact that we have yet to make a lot of progress on inflation. And she says that the next data that is coming out before the next FOMC meeting will be crucial in determining whether or not we actually need more interest rate hikes. But she does not rule out more interest rate hikes. So it's either a pause or further interest rate hikes. Now, what most Federal Reserve officials have reiterated is they have really made it clear that the problem is the labor market. It is very hard to bring inflation back to the 2% target with such a tight labor market. In fact, the Dallas Fed President Logan said that job growth is more than twice what is required to keep up with the growth of the labor force, indicating that the labor market is very tight. We're seeing a declining unemployment rate. And if job growth is so much higher than the growth of the labor force, that of course also puts upward pressure on hourly earnings, right? On wages in general. And like Larry Summers said, you cannot get inflation down without getting wage inflation down. And in order to get wage inflation down, you need slack in the labor market or a rising unemployment rate. Now, we also got comments from the St. Louis Fed President Bullard. He basically said today that, quote, I do expect this inflation, but it's been slower than I would have liked, and it may warrant taking out some insurance by raising rates somewhat more to make sure that we really do get inflation under control. Very interesting, talking about the fact that we need some insurance because we don't have sufficient evidence that inflation is on a sustainable downward trajectory. And he also said, very interesting, our main risk is that inflation doesn't go down or even turns around and goes higher as it did in the 1970s. I keep on reiterating this. The Federal Reserve will not cut rates until it is sure that inflation is on a sustainable downward trajectory. It might not even pause before it knows that inflation is on a sustainable downward trajectory. We have heard similar comments from the Cleveland Fed president. So it is very, very important that the data continues to support falling inflation. And in order, what the Federal Reserve is focused on is the labor market resilience of the consumer, and obviously inflation. Consumer remains resilient. We will get to that later with the retail report. The labor market remains tight, and inflation, we're not making enough progress on inflation, especially core CPI, core PCE, excluding the very volatile food and energy prices, is remaining very sticky. Now, we also got comments today from the Fed Governor Philip Jefferson. He basically said last week that inflation is too high, but in addition to that, he did acknowledge that GDP has slowed considerably this year. But he also said that while inflation has come down substantially since last summer, it is still too high, and by some measures, progress has been slowing. So overall, if you look back at the week, other comments from Fed officials, including Neil Kashkari, Raphael Bostic, all of these Fed officials sound relatively hawkish, and that is why we're also seeing the Treasury yield curve steepen a little bit. We're seeing yields up across the curve because of these hawkish comments from Federal Reserve officials, and it all comes down, and this is what I'm going to recommend to investors as well. Pay the most attention to the labor market report, to any sort of data about the resilience of the consumer, and obviously inflation. Manufacturing data, of course, also important, but the most important data is the labor market and the resilience of the consumer, because without slack in the labor market, you're not going to get inflation back to the 2% target. The only thing that you really need to consider is that monetary policy affects the economy with a significant lag. And speaking of data, speaking of labor market data, jobless claims came in lower than expected at 242,000, which is down 22,000 from a week earlier. This is a significant decrease compared to a week earlier, but you need to consider that last week's upward surprise was caused by fraudulent data from Massachusetts. So last week, the jobless claims data that we got last week is actually not so reliable. Pay attention to this week, and it is showing that jobless claims are still very low. All right. Before we get to the debt ceiling, I would like to mention one more quote coming from Morgan Stanley today, Catherine Simonetti, Morgan Stanley Private Wealth Management. She said that, quote, "The big decision for the Fed is the timing, because once they announce that they're done raising rates, markets are just going to assume that they've succeeded, and it might not necessarily be the case. Inflation so far is proving to be sticky," end of quote. So she's also acknowledging that inflation is sticky. She is also kind of acknowledging that the Fed has more work to do, and she's kind of highlighting the importance of inflation expectations. It is very important that inflation expectations remain well anchored. If you look at the Fisher equation, the nominal rate, actually the real rate, equals the nominal rate minus the expected inflation rate, meaning that as inflation expectations rise, your actual real rate based on your nominal rate is lower, indicating a less tight environment, meaning that inflation will be harder to bring down. And this is very intuitive, because rising inflation expectations mean higher wages, mean higher prices, and consumers might also be actually forwarding their spending to now because they expect higher inflation. So it is very important for the Fed to keep inflation expectations well anchored in order to actually bring inflation down to the 2% target. Something very important to consider as well. Debt ceiling debate, third day now that this is a topic here on this YouTube channel. But this is also a topic that is causing a lot of optimism in markets, actually. So that is why I keep mentioning it. Now, what McCarthy said again today is that he's seeing continuously optimistic around a potential agreement, maybe even this week over the weekend, maybe next week. So he said that a deal could be reached soon. And Republicans as well as Democrats actually acknowledged that a default is not an option. So that is obviously boosting optimism here in markets that a technical default will most likely, as also stated by the United States Constitution, will most likely be avoided, which is very important. All right, let us get to our Walmart earnings. Right, Walmart surprised to the upside today with earnings. Walmart is it's an absolutely incredible example. I will talk about this a little bit in a second, but let us get to the numbers first. Earnings per share at $1.47 adjusted versus an expected 1.32 here. This data is from CNBC. Revenue came in at 152.3 billion, also higher than expected. Expected was revenue of $149 billion, around 149. And what the current earnings report from Walmart shows is that the consumer is in a relatively healthy state. He or she is still spending money. But you need to consider the gross margin rate for Walmart actually declined in the first quarter, which indicates that consumers are actually spending and more essentials, indicating that we might be starting to see a consumer that loses some of his or her resilience. Now, the CEO of Walmart told investors today that Walmart is actually attracting more wealthier consumers. And that is what is so beautiful about this company. Walmart, in case of a recession, right, they're not only left with the low income consumers, but they actually attract the high income consumers as well. And that is why Walmart is such a stable company. That is why I also don't expect Walmart to come under significant pressure, even if we get a recession, because simply the wealthy consumers are going to start shopping at Walmart. And that's what makes this such a special and beautiful example. Now, some more quotes coming from the CEO of Walmart today. He said that, quote, "We're seeing in these economic indicators that there is some strain on the consumer, but the resilience has surprised us," he told CNBC today. He also said that, quote, "And I think that's in part probably because balance sheets are much stronger than they were pre-pandemic, even at this point." So he's kind of talking about the macroeconomic complications that were created by all the COVID stimulus. Stronger consumer finances have increased spending power at the bottom of the income distribution. In addition to that, the post-pandemic distribution of income gains, those two things will create macroeconomic implications, or they have created macroeconomic implications, because they put the consumer in a very resilient position, which means that the consumer can keep spending, which in turn will make it harder for the Fed to restore price stability, all indicating that the Federal Reserve has to keep rates at a higher level for longer. Now, retail sales, the current earnings report, we got earnings from Target, JSX Group, now Walmart, Home Depot. What are these numbers actually telling us about the consumer? Now, like I said, Walmart is getting a boost from wealthier customers, but a common trend that we have seen with all these retailers reporting earnings is that there's less spending on discretionaries and more spending on essential items, indicating that the consumer is indeed starting to lose some resilience. We're crawling towards a recession. Now, Target reported that comparable sales, they expect comparable sales within a single-digit decline or single-digit increase throughout this fiscal year. And the question is this an actual ideal environment for Walmart? I touched upon this a second ago. Ideal environment for Walmart because it also attracts the wealthy consumers now, which will help Walmart to keep up its revenue, keep up its earnings per share, right? So less downward pressure on the stock as well, less pressure on the company as a whole, because they're able to attract these wealthy consumers. Overall, we're still seeing that the consumer is resilient. We're starting to see less resilience. Retailers are worried about the strength of the consumer, especially Target, which is a company that is kind of dependent on discretionary items. So definitely interesting what these companies are telling us. But overall, we're only crawling towards a recession. And in my opinion, the Federal Reserve does not have sufficient evidence at the moment that inflation is indeed on a sustainable downward trajectory. And this opinion is also reflected in the fixed income market today. And now let us get to fixed income, a beautiful topic. A beautiful article was released from Barron's today. It basically said that since the year 1990, the Fed usually paused for 10 months before actually cutting rates, right? So that would mean if the Federal Reserve would actually pause now at the next meeting, it would, according to history, start cutting 10 months after this. So actually not this year like markets expect. Now, every time, and this is where it gets very interesting, every time the bond market rallied, and then, okay, let me phrase it differently. Every time since the 1990s, when the Federal Reserve actually announced that they will pause now, the bond market rallied, right? Rising prices, falling yields, actually, yield curve does not steepen. You continue to see falling yields. But then volatility follows. And then essentially when the Federal Reserve actually cut rates, you see steepening of the yield curve again. Now, what this means is that according to BlackRock, we now actually have a generational opportunity in fixed income, right? And Christy Akullian, the senior iShares strategist at BlackRock, believes that the sweet spot on the yield curve is actually between about 3 and 7 years, so kind of at the belly of the curve, not at the long end, not at the short end. Very interesting topic. If you think about, this is very interesting, the fact that the Federal Reserve starts to cut rates usually 10 months after a pause. You need to ask yourself, why are the markets so eager to price in rate cuts? Why do the markets believe we will already see rate cuts in June this year? Why does the market believe that we will see 3 rate cuts throughout this year? The reason for this is the markets are just reacting to the data. What the markets are seeing is a resilient economy. At the same time, they're seeing inflation fall. But you need to listen to the Fed. You need to look at the labor market. You need to look at the strength of the consumer. And it's completely unrealistic because the Federal Reserve cuts rates for 2 reasons. Either you get a significant fall in inflation or you get a recession. Right now, neither of those seems to be an unlikely scenario in 2023. So it seems to be unlikely as well that the Federal will cut rates because it essentially, the chances are high that it will not have a reason to, especially if you consider that the banking sector is actually now in a pretty good state again. We're basically now where we were before the Silicon Valley Bank collapse. All right, that is it for today's closing bell coverage. I hope you enjoyed today's video and have a great evening. See you again tomorrow.